Well, I want to welcome everyone to our webinar for today, Unlocking the Potential of the Employee Retention Credit. And I would like to welcome Matt Edelman, the Managing Director at Strategic Tax Planning. I have to say that I'm so thrilled and grateful to Matt because he is a local tax expert who's able to share this expertise and support our home care community in navigating the employee retention credit. So Matt, welcome and thank you. Maybe I can share a little bit about you, and if there's something that I miss, please fill in the gaps here. Matt Edelman brings more than 2 decades of professional experience in tax, controversy, accounting, financial planning, and small business management and consulting to the strategic tax planning team. And he is one of the nation's leading experts on the employee retention credit and other COVID relief programs. He excels in planning opportunities in the Internal Revenue Code, offers taxpayers to ready themselves for the challenges brought about by the rapidly changing financial landscape. Matt is native of the nation's capital here, and he's a graduate of Shepherd University, where he studied business administration and financial economics and completed the university's CFP board-approved program in personal financial planning. He is an IRS enrolled agent, and he'll tell us what that means. So he represents U.S. taxpayers around the world, helping them to minimize their tax burdens and navigate the IRS's complex regulatory and compliance requirements. He resides with his wife on the Chesapeake Bay's Western Shore, but please do not ask him if he's had time to fish, because he's been very busy. Matt, I will turn it over to you. Thank you and welcome.
Absolutely. Thank you so much, Caitlin. I appreciate it. So thank you, everybody, for joining me today. We are here to talk a little bit about the employee retention credit. This certainly has become a increasingly hot button issue with the IRS as the claims for this credit have accelerated. And I will just say that there have been some, we'll just say, unscrupulous providers that have entered this space, especially over the last 8 or 10 months, that I think it makes it important that all taxpayers that are potentially eligible for this credit are aware of their potential eligibility, but also aware of the appropriate way to go about claiming this credit. So I will go ahead and get started with the presentation. Again, thank you so much for joining me. So just a little bit about myself. I think Caitlin pretty much covered everything on the screen that I already had typed out here. But again, I've been working in taxes and accounting for a couple of decades now. I am an IRS enrolled agent. That is a license that is awarded by the IRS and allows me to represent any U.S. taxpayer anywhere in the world before the IRS. This is basically, you can think of me as kind of like a CPA, but all I do is taxes. And so I could probably bore you all to tears if you gave me the opportunity. Anyhow, just to give you a little bit of a pre-cap, we'll call it, about what we're going to be talking about today. So first, I'm going to give you a little bit of information about what the employee retention credit is, then tell you a little bit about who it is applicable to and the ways that businesses can qualify for the ERC. Also, we'll talk a little bit about what the potential value is and what this credit might be worth to eligible employers, as well as a little bit about our process about how strategic tax planning evaluates our prospective clients for eligibility for the credit and estimates the credit that we might be able to claim for our clients. So let's go ahead and tell you a little bit about strategic tax planning. So STP, as we call it, is a licensed Maryland CPA firm. We are based out of Annapolis and have a team of multidisciplinary tax professionals. So we've got probably about 15 CPAs on staff at this point. I would say 10 or 12 tax attorneys, a couple of enrolled agents like myself, as well as a large bench of accounting professionals on staff as well. STP, we primarily focus on advising clients on the tax credits and incentives that are offered, like Caitlin said, by the complex Internal Revenue Code. And I've been focusing, especially on the last couple of years, on helping my clients obtain COVID relief monies that were made available to them primarily via the CARES Act. So let's go ahead and talk a little bit about the ERC. So what is the ERC? The Employee Retention Credit. This is a fully refundable tax credit that is a payroll tax credit claimed on a business's payroll tax returns that were filed with the IRS. Most of the employers that we're talking to today, I imagine you all file a form called a 941 at the close of each calendar quarter in order to report the payroll, or excuse me, the wages that were paid to your employees and to remit the payroll taxes that were withheld from their paychecks. This is the form that is used to claim the employee retention credit. Now we'll get into how this all works in a little bit greater detail momentarily, but a couple of things to emphasize here. Primarily, this is a lot different than the PPP loan, which is probably the other COVID relief provision that the greatest number of employers took advantage of during the pandemic. The biggest and most important differences between the PPP and the ERC is this is not a loan and there are no strings attached to this money. So with the PPP, you might remember that a business had to spend at least 60% of the loan proceeds on payroll, and then the remainder of the proceeds on operating expenses in order to get the loan forgiven. Well, with ERC, there are no stipulations such as those, meaning that the refunds that a business receives via a claim for the employee retention credit, these are uninhibited funds. There are no strings attached. A business can use these funds to expand their facility, increase payroll, or if the owner sees fit, just simply issue this as a distribution once the credit is received. But the main reason that this credit exists is as a way to help reward employers for having kept their employees on payroll during the pandemic, and let's face it, allow those employees to keep feeding their families during what was clearly a pretty tough economic climate. So let me give you a little bit of background about the CARES Act and the Employee Retention Credit. So first, let me note that the Employee Retention Credit, this actually predates the COVID-19 pandemic. The ERC came into existence actually in 2006 as part of the Hurricane Katrina relief package that Congress passed at that point. But that was revived, for the COVID-19 pandemic as part of the CARES Act, which was the first big piece of relief legislation passed early on in the pandemic. So you may recall that the CARES Act brought into existence many of the COVID relief provisions that we're now familiar with, including the PPP loans, the Employee Retention Credit, Economic Injury Disaster Loan, which was later converted to a grant, and also other grant monies for other types of industries, such as the Restaurant Revitalization Fund and the Shuttered Venues Operators Grant. However, what we're here to talk about today is, again, the ERC, which was revived as part of the CARES Act. Now, when the CARES Act was first passed, Congress said that a business had to choose. They could either get an employee retention credit refund, or a business could choose to request a PPP loan. However, these were mutually exclusive when the CARES Act was first passed, meaning that a business had to pick one or the other, but you couldn't do both. Well, that all changed with the passage of the Relief Act in December of 2020. With the passage of that piece of legislation, Congress said that, well, you know what? Even if you already got a PPP loan, you can get the ERC. You can even go back and claim the ERC retroactively. The one stipulation, however, that Congress provided at that point was that a business cannot double dip, as it's called, meaning that a business is not allowed to claim the employee retention credit based on wages that were paid with a forgiven PPP loan. However, it is important to mention that, again, having received a PPP loan is not dispositive of a business being able to claim the employee retention credit. It merely means that we can't claim the credit and use the loan for the same set of wages. So the CARES Act initially put the employee retention credit into place for 2020. The Relief Act extended the availability of the ERC into the first 2 quarters of 2021. And then with the passage of ARPA, the American Rescue Plan Act of 2021, in March of that year, Congress again extended the ERC availability into the 3rd and 4th quarters of 2021. However, then come November of that year, with the passage of the Infrastructure Act in November of 2021, Congress pulled the rug out from under a bunch of my clients, let me tell you. So because the employee retention credit after the passage of ARPA was available into the third and fourth quarters of 2021, I actually had clients that had stopped paying payroll taxes during those quarters in anticipation of receiving an employee retention credit refund. And then with the passage of the Infrastructure Act, midway through the fourth quarter of 2021, Congress then said, well, we're actually not going to allow a business to claim the credit during that quarter. So I had a bunch of clients that, again, had stopped paying their payroll taxes for 6 weeks and had to scramble to catch up on their payroll tax liabilities because Congress changed the rules for what was at that time the third time for the existence of the ERC during the pandemic. So thanks a lot, Congress, for making this easy on us, right? So just to touch on what the legislative environment is today surrounding the ERC, I've received a lot of questions recently as to what does the recent debt ceiling negotiation and subsequent legislation, how is that going to impact the ERC? So a couple things to note here. Bottom line is it doesn't. So there is some talk, and there was a provision in the passage of the debt ceiling legislation that made it so that certain unobligated COVID relief funds were going to be clawed back by the federal government. However, this generally applies to things such as the provider relief funds. So here we are in 2023. This particular fund has been in place for getting close to 3 years at this point, and there were still undistributed funds remaining in the provider relief fund maintained by the Small Business Administration. Because those funds had not yet been distributed and were not yet obligated towards any particular employer, Congress decided to take some of those monies back as a way to balance the budget and balance the bill for the debt ceiling negotiation. The employee retention credit, on the other hand, this is not a grant like the provider relief funds or the restaurant revitalization funds or other grants that are administered by the Small Business Administration. Instead, the employee retention credit is just that. It is a tax credit, a payroll tax credit that is claimed by a business on its payroll tax returns. And the refunds are issued by the Department of Treasury and paid out of the federal government's general fund. And so because these are not funds that were specifically earmarked for a particular COVID relief program, these funds were not affected by the recent debt ceiling negotiations. So let's talk about a little bit more about the specifics of the ERC. So the ERC is generally available for all 4 quarters of 2020 and the first 3 quarters of 2021 now, since the IRS stripped the availability of the credit for the 4th quarter of 21 for most businesses. Now, to get a little bit more specific, the credit actually first becomes available during the middle of March of 2020, starting on March 12th of 2020, which is right when the pandemic really started to hit home. I'm sure everybody here on this call remembers that Friday the 13th of March of 2020, when Governor Hogan first issued the big initial stay-at-home order, which began to shut down the economy. I'll certainly never forget that day. So the ERC generally becomes first available during that week of March of 2020. And for most businesses, again, is available through the end of the 3rd quarter of 2021. Now, certain types of businesses, specifically those called recovery startup businesses, are still potentially eligible to claim the employee retention credit for the 4th quarter of 2021. And this is the only type of business that can claim the credit for Q4 of 2021. Recovery startup businesses, those are a little bit outside of the scope of this presentation, but basically what this means is a business that began operations during the pandemic, specifically after February 15th of 2020, and also has a certain annualized gross receipts cap in order to qualify as a recovery startup business. However, if a business is qualified as a recovery startup business, it is generally eligible for the ERC automatically for both the 3rd and the 4th quarters of 2021. So let's talk about who is eligible to claim this money. So the ERC is available to eligible employers, meaning an employer which was carrying on a trade or business during the calendar quarter for which the credit is determined. Again, one of the 4 quarters of 2020 or the first 3 quarters of 2021, generally speaking, and who satisfied one of the 2 following tests. So there are 2 main ways for a business to be eligible for the ERC. The first is having suffered a significant decline in the business's top line gross receipts during the pandemic. And then the second is what we'll call the government mandate test, and that's available to businesses that experienced what the IRS calls a full or a partial suspension of operations during the pandemic as the result of the government orders that were in place at the time. So we'll get into those in a little bit more detail separately. So let's first talk about how the test works for experiencing a decline in gross receipts. So there are different rules as to how this test works, depending on if we're talking about quarters during 2020 versus quarters in 2021. So for a business to first be eligible based on experiencing a decline in gross receipts during a quarter of 2020, the way that we determine this is we look at the gross receipts brought in by the business during each of the quarters, again, of 2020 and the first 3 quarters of 2021, and compare the gross receipts from the quarter, or excuse me, for the business from that quarter with the gross receipts of the corresponding calendar quarter of 2019. So what this means is, for example, we're looking at the gross receipts of the business during the second quarter of 2020 in comparison with that number from the second quarter of 2019. Or, for example, the third quarter of 2021, again, looking back to the third quarter of 2019. We're always going to be looking back to 2019 as our benchmark for comparison, the thinking there being that at least that was some semblance of normalcy prior to the beginning of the pandemic. So what we're looking for in 2020 is a decline in gross receipts of at least 50% during any quarter of that year in comparison with the same quarter of 2019. So a pretty significant decline that we're looking for during 2020. During 2021, however, that threshold becomes a little bit easier to meet. In 2021, we're merely looking for a 20% decline in gross receipts during any of those first 3 calendar quarters of 21, compared to, again, the corresponding calendar quarter of 2019. And there are a couple of additional complexities associated with this test. I'm not going to get too much into the weeds on this, but basically the way that this works is if a business is initially eligible for the employee retention credit, it is generally eligible for the subsequent quarter of the year as well, based on the declining receipts that the business experienced during the prior quarter. And then a couple other nuances, including the alternate quarter election, it's called. What this does is this allows a business to use the previous quarter's revenue decline to qualify for the current quarter based on the current quarter's applicable threshold. So really this only comes into play during the first quarter of 2021 because there are differing thresholds between 2020 and 2021. What this means is that if a business experienced a 20%, between 20 and 50% decline in gross receipts during the fourth quarter of 2020, while it does not exceed that applicable threshold of 50% that's applicable to 2020, what that does is it actually makes the business eligible for the first quarter of 2021 based on a decline in gross receipts. Now, let's move on to speaking about the second test, the government mandate test, which is really where my team at Strategic Tax Planning can offer the most value to our clients. Because let's face it, the decline in gross receipts test, this is pretty tangible. This is rather black and white. This is what it really comes down to, is a math problem to determine whether or not the business experienced a decline in gross receipts. However, this government mandate test is more subjective and a little bit more elusive, we'll say. And so what this means is that, many of the accounting firms and CPAs that we've worked with and interacted with in the last couple of years, they're very, very familiar in how to apply the first gross receipts decline test. However, because of the subjective nature of this government mandate test, they're less comfortable providing an opinion or analyzing the eligibility of a business based on this second avenue to eligibility. So let's talk about how this government mandate test works. So if your business experienced operational disruptions as a result of a government order during the pandemic that required you to make modifications to the business that limited your ability to provide your goods or services to your patients or customers, this can potentially make your business eligible for the credit for the duration that it experienced this effect on its ability to provide its services. So just some very quick examples of what are some applicable government orders that we would be talking about for businesses in the home health space. First example would be that of quarantining. So, it was a very obviously staffing was a very sticky, very difficult issue for businesses in this space during the pandemic. So that when you add to that already having limited staff and then having staff members that, because of whether it was a COVID infection or potentially a contract tracing issue, to have these staff members unable to go to work and to provide their services for what was usually at least 72 hours, sometimes a significantly longer period, that only exacerbated the business's ability to provide its services to its patients. Another good example here are the increased cleaning and sanitization standards that were required during the pandemic, which, depending on the jurisdiction that we're talking about, required, at least here in the state of Maryland, for example, the Maryland Department of Health required businesses in this space to do things such as wipe down every high-touch surface area in the facility in which work is being done multiple times throughout the day, just as one example. And so because of the increased labor associated with employing these enhanced cleaning procedures, this reduced the ability of these businesses' employees to provide services to their clients and to their patients. Another big example for a space, for an industry rather like this, is the fact that you all were all locked out of getting into hospitals, assisted living facilities, skilled nursing facilities, etc., for various reasons, but especially when you all have been going into these facilities to market your services. Many of the home care industry businesses that we've worked with here at STP generate a very, very substantial amount of their businesses by garnering referrals from the healthcare practitioners that they interact with in these facilities, again, such as hospitals, assisted living facilities, residential care facilities, etc. And so because the Center for Medicaid or Medicare Services and the Centers for Disease Control restricted access of many what they deemed to be non-essential visitors into these facilities during the pandemic, this severely impacted many of these home care industry businesses' ability to market their services to their referral sources. So what this means is these are examples of how the modifications a business might have had to make during the pandemic to its operations to comply with the government restrictions that were in place at the time, how these modifications might make the business eligible for the ERC. So let's talk about this in a little bit more detail. So there are basically 3 pillars that we have to satisfy in order for a business to be eligible for the employee retention credit based on this second avenue to eligibility, this government mandate test. The first is we have to analyze and determine, was there an order or a mandate in place during the pandemic that was applicable to the business being analyzed? And was this order issued by an appropriate governmental authority? And, unfortunately for your industry, these appropriate governmental authorities, as they're called by the IRS, they were numerous. There was a multitude of these authorities that were handing down guidance to the businesses in this industry throughout the pandemic, whether it was coming from the Maryland Department of Health or the Department of Health in the state that you're located, the governor in that state. Often there were restrictions that were even more restrictive than the statewide restrictions, particularly here in Maryland in jurisdictions such as Baltimore County or Montgomery County, where there were very specific mandates coming from these county executives. You were also having to deal with orders that were being handed down by CMS, OSHA, the CDC. These orders were coming from all sorts of different angles for businesses in this space during the pandemic. So the second pillar here is we have to determine what was the duration of the order that was in effect that was issued by this appropriate governmental authority. So I'll give you an example here. In Maryland, the Maryland Department of Health required that all healthcare practitioners statewide, no matter what specialty you were involved with, they were required by code to adhere to the CDC's COVID-19 infection control guidance. And this requirement was in place through June 15th of 2021 and was first set forth in the very early days of the pandemic in late March of 2020. So what this means is that there was this government order that was applicable to almost any healthcare practitioner in the state that would have been in place from March of 2020 through June 15th of 2021, requiring them to adhere again, by code to the CDC's infection control guidelines, which required these practitioners to do things such as maintain social distancing at all times, restrict access to their facilities of non-essential visitors, employ enhanced cleaning procedures, employ aerosol mitigation methods, etc. And so again, lots of orders coming from many different angles, but one of the important things that we have to do is identify the specific time frame that these orders were in place and would have been applicable to the businesses that we're analyzing. And then the third thing that we have to show is that the operational disruption that resulted from the modifications the business had to make to its operations to comply with the government orders that were in place. We have to be comfortable with saying that these operational disruptions created what the IRS calls a more than nominal effect on the business's ability to provide its goods and services. So this is another nuanced portion of this analysis. So first, let me say that this more than nominal effect, this is a subjective test. We're looking at all of the facts and circumstances that were, present at the time that we're analyzing the business's eligibility for this credit. However, the IRS has provided us with an objective safe harbor, which is to say that if a business can say that its ability to provide its services to its clients or patients was diminished by no less than 10%, then the business will be deemed to be eligible for the ERC for the duration of time that it experienced this more than nominal effect on its ability to provide its services. So let me give you an example to highlight this. If your business, because of all the modifications it had to make to comply with the orders that were being set forth by CMS specific to home health agencies during the pandemic, if the modifications that the business had to make to comply with these orders reduced your ability to provide your services to your patients by 10% or more, that is the test that we need to satisfy. That is what makes this business eligible for the ERC based on having had its operations disrupted by a government order. So just to summarize and put it this simply, in order for us to analyze a business's eligibility based on this government mandate test, we have to look at three questions. First, were there governmental mandates imposed on the business during the pandemic, and were they required? Meaning, was this a mandatory modification that the business had to make to its operations? We can't base government guidance or recommendations as the basis for eligibility for this business. This has to have been a mandatory and required modification to operations. Then we have to ask next, what was the duration of time that these orders and mandates were enforced and in place that would have affected the business's operations? And then thirdly, we have to ask, was the business's ability to provide its goods or services diminished by at least 10% as the result of the modifications that the business had to make to its operations? So let's talk a little bit now about what the ERC is potentially worth to a business like yours. So the way that the ERC is calculated works differently for 2020 versus 2021. In 2020, the credit is worth 50% of the first $10,000 in qualified wages paid to an eligible employee during the period of the business's eligibility for the credit during 2020. What all that means is that the maximum credit available per employee during 2020 is a maximum credit of $5,000. Then, however, in 2021, the credit gets to be more valuable. In 2021, the credit is calculated as 70% of the qualified wages paid to each employee up to $10,000 per quarter. What this means is that there's a maximum credit available of $7,000 per employee per quarter in 2021. So a maximum credit of $21,000 per employee in 2021, plus a maximum credit of $5,000 per employee in 2020, leaves us with a maximum potential credit of $26,000 per employee that was employed by the business during its period of eligibility during the pandemic. Now, there are a couple of limitations and exclusions that we do have to mention. The first is, so there are certain employees that are not eligible for the ERC. So owners of a business that own a majority of the outstanding interest of a business, so more than 50% owners of the business, wages paid to those individuals are not qualified for the ERC. nor are wages paid to any of that majority owner's blood relatives. Now, it's not quite so broad to say any blood relatives. There are some restrictions. Basically, we're looking at any number of generations up or down. Those relatives are excluded, and essentially one relationship sideways, meaning that your brother's wages, you can't claim your brother's wages as qualified wages for the credit, but you could, for example, claim wages paid to your second cousin as qualified wages for the credit. Now, another limitation to mention is, like I said earlier, PPP wages. So businesses cannot double dip, as the IRS calls it, meaning that a business that paid wages with a forgiven PPP loan cannot use that same amount of wages funded by PPP to claim the employee retention credit. However, again, having received a PPP loan does not preclude a business from claiming the employee retention credit, nor is it required that the same wages, the same exact wages paid with a PPP loan be excluded from the ERC. What this simply means is that the gross amount of wages that a business used to satisfy forgiveness of the PPP loan, that gross amount of wages must be excluded from the calculation of the ERC available to that business. And so what that does is that allows us some opportunity to further optimize the credit. That's a bit of a nuance that many practitioners are not aware of, that there is this flexibility to reallocate wages in a way that will sometimes produce a more beneficial outcome to the taxpayer. So another thing to mention here is that the determination of whether a business is considered to be a large employer versus a small employer has a significant impact on the types of wages that a business can claim as qualified wages for the ERC. So let me first say that both large employers and small employers, eligibility for each of those types of employers is determined the same way. However, the fact that business is considered to be a large employer changes the statutory definition of what is a qualified wage for a large employer. So let's talk about how we determine whether a business is a large or a small employer. So we are always going to be looking back to the average number of full-time employees that a business had on payroll during 2019 as the test period to determine whether or not a business is considered to be a large or a small employer. However, the rules work differently for 2020 versus 2021, as they do for so many other aspects of this program. So again, we're always looking back to 2019 as our test year to determine how many average full-time employees were on payroll during 2019. If during 2019, the business had more than 100 full-time employees on payroll, the business would be considered to be a large employer for 2020. However, for 2021, that threshold increases to 500, meaning that a business can have on payroll during 2019 up to 500 full-time employees, and during 2021 still be considered to be a small employer. Now, there are some additional rules that need to be taken into consideration here concerning aggregation of entities. I won't get too much into the weeds on this because this is a very nuanced topic. However, there are rules concerning the determination of what are called a controlled group of entities that are an aspect of the analysis that we have to take into consideration when looking at a business for the employee retention credit. What this means is that if we have multiple businesses, multiple entities that are under control of a common group of owners, then those businesses are often considered to be a controlled group of entities, meaning that this controlled group of entities must be considered together as basically one large entity when determining whether or not those businesses are eligible for the employee retention credit. So what does this all mean? So for businesses that exceed the applicable employee count thresholds and are considered to be a large employer for whether it's 2020 or 2021, a large employer can only claim wages that were paid to its employees who were not providing services to the business at that time as qualified wages for the credit. So this does have the effect of limiting somewhat the wages that can be claimed by a business to use or to calculate rather the employee retention credit. So I'll give you an example. Many of the nonprofit businesses that we work with here at Strategic Tax Planning, they sent a lot of their employees home, sometimes for a couple of months early in the pandemic, but continued to pay those employees because they knew that they were going to have trouble rehiring them once the pandemic ended and getting them to come back to work. Now, that's not really something that is honestly applicable in most circumstances to home health agencies, because let's face it, you all never had any slowdown in your work. Being some of the most essential employers in the country, there was no way that you could send your employees home without, or excuse me, and continue paying them without having to have them work, except in some pretty limited circumstances, such as when an employee had to stay home with COVID, for example. And so most businesses in the country were required to continue to pay sick leave wages to employees that were homesick with COVID, even in excess of the allocated PTO available to that employee. And what this does is has some interesting effects, because so there was a credit called the Families First Coronavirus Response Act credit, which was one of the COVID sick leave credits available to businesses during the pandemic. However, businesses that had over 500 full-time employees, they were not eligible to claim these sick leave credits in many circumstances. However, these large employers are still eligible to claim the employee retention credit on those wages that were paid to employees who were not working at the time. And so what this does is created an interesting effect where certain businesses were too large to claim the expanded COVID sick leave credit. However, because they couldn't claim that credit, they can use those same wages to claim the employee retention credit. Now, one other very important nuance that is highly applicable to home health agencies is how we determine who is considered to be a full-time employee. So first thing to note here, and this is a very important nuance, is that we are looking at strictly the average number of full-time employees on payroll for the business during 2019. We are not looking at all at the number of full-time equivalent employees. And that's an important nuance because, first of all, most business owners, when you start talking about your full-time employee count, often will default to the full-time equivalent count because of the ACA implications of that count. However, we're not looking again at full-time equivalents. We're strictly looking at full-time employees. And this is a cliff, meaning that the way that we determine if a business or an employee rather is considered to be a full-time employee is we look at the number of hours that the employee worked in each month of 2019. And if for that month, the business or the employee rather worked 130 hours or more during that month, that employee is considered to be a full-time employee for that month. However, if that same employee worked 129.9 hours during the month, they do not count towards that full-time employee count. And this is especially important for this particular industry because of the, both the transient nature of the workforce, but also the especially high number of part-time employees that are often employed by home health agencies. So again, this is important to note because we have worked with certain home health providers that had as many as 1,000 employees on payroll during 2019. But because of the low number of those employees that were working full-time schedules, they were still considered to be a small employer for purposes of the ERC for 2021, even though that they had 1,000 employees on payroll. So again, that's a very important point to drive home. So just to give you a quick recap, let's talk about, again, real quick, what is the employee retention credit? This is a very, very lucrative payroll tax credit, a form of COVID relief money that's available to employers that suffered during the pandemic, either because of a strict or a significant decline in gross receipts experienced by the business, or because of their reduced ability to provide their goods and services resulting from some sort of government order that impeded their operations. This is applicable to businesses that have W-2 employees on payroll, and only W-2 wages can be used to claim the employee retention credit. There are two main ways for a business to be eligible. Again, either a decline in gross receipts or a partial or full suspension of operations. And the credit is worth as much as $26,000 per W-2 employee that the business had on payroll during the pandemic. So a couple, final things to note here, and then I'm going to go ahead and open it up to a question and answer session so that I can make sure that everybody is leaving with everything in their mind answered. So, I do want to highlight, as I mentioned early on in the presentation, so I've been doing this for close to 2.5 years now, helping my clients obtain COVID relief monies, including PPP loans, employee retention credit, shuttered venue operators grant, etc. And I've noticed that particularly, in the last 6 to 8 months, there have been a lot of what I called earlier unscrupulous vendors that have entered this space. I'll also use an alternate descriptor for them, and that is, we'll just call them opportunists. And so the ERC, not unlike the PPP loan program, has some significant opportunity for fraud. And so there have been some providers that have entered this space that have been filing some claims using some pretty aggressive stances and sometimes unsubstantiated stances for their clients to claim the ERC, and are doing things that are some big no-nos, such as some of the things I have listed on the screen here, such as double dipping with the PPP, meaning that their businesses are not backing out the PPP loan payroll from their calculations of the ERC. It has been a big problem with what the IRS calls ghost preparers recently, meaning that you have engaged a business to help you file an ERC claim, but that business is refusing to sign the 941X, which is the form that's used to claim the credit. They're refusing to sign that claim as the paid tax return preparer. And this has been a big concern, big ethical concern of the IRS for the last couple of years, as we've seen this practice increase substantially since the beginning of the employee retention credit. Another big issue has been that the business and the provider has not been properly documenting the basis for eligibility for the credit, whether that is by documenting the decline in gross receipts experienced by the business, or what we're seeing far, far more frequently, not properly documenting what was the cause of the suspension of operations that the business experienced, meaning that you need to hold on to the copies of these government orders that you're basing your assertion of eligibility on. Another big issue we've seen lately has been just what I'll call negligent overclaims, meaning that a business or a provider is simply claiming the maximum amount of credit available to an employee, irrespective of the amount of wages that that employee actually earned, or also claiming quarters that a business sometimes is not actually eligible for the ERC for. Another big one that I've seen with some of these opportunistic providers, I'll call them, has been they have just been using a self-qualifying questionnaire, basically just sending a taxpayer a questionnaire that says, were you affected by a government order? Oh, yes. Okay, well, then you're eligible for $1 million ERC refund. Well, unfortunately, it really is not quite that simple. Again, I've been working in tax law for quite some time, and this is really, without question, probably the most complex section of the tax code that I have encountered in my career, which really is unfortunate given the fact that this program was put into place to help get money in the hands of employers as quickly as possible during the pandemic. Well, the Congress really bungled the rolling out of this program big time, if you ask me. So let me tell you just a little bit about how our process here at Strategic Tax Planning works. So first, the way we get started on this is we will get some basic documentation from the business, including information on P&Ls, quarterly P&Ls from 2019 through 2021, in order to perform our gross receipts test analysis. We also request quarterly payroll reports for the businesses, employees who are on payroll during the pandemic, as well as information on any PPP loans that the business received. This way, we can work to put together an estimate of the potential credit that is available to the business. But first, what we do is we set up a call with the taxpayer and one of our licensed tax professionals on staff so that we can get an impact statement to dig more into how the business's operations were affected by the government orders and the government mandates that were in place during the pandemic. With that, in combination with the gross receipts analysis that we will have performed, we can determine the period that the business is eligible for the ERC And then based on that eligibility period and using the quarterly wage data that we obtain to provide this initial analysis, we are able to provide a business with the estimate of the potential credit that is available to be claimed. Once we have that estimate available, we generally set up a follow-up call with our prospective client to deliver our findings, where we can say, this is how long we think the business is eligible for the credit. This is how much credit we think is available for the business to claim. And based on all this information, we can determine the complexity of the work that is to be done to claim the credit for the business. And at that time, we'll be able to provide you with a quote for our fixed fee that would be required to fund the services necessary to file the ERC claims, the fourth step of our process. Now, one thing I do want to mention is, unfortunately, dealing with the IRS, I'm sure everybody on the call has been hearing about the delays and the backlogs at the IRS for, let's face it, several years now. So while it usually takes us just between 6 and 8 weeks for us to get the claims filed for our clients, we're generally seeing wait times of in the neighborhood of about 6 months from the date of filing for a business to begin to receive its refunds of the ERC credit that is being claimed on its behalf. So just to give you a couple of examples of some of the outcomes that we've been able to achieve for our clients. One example here is a specific North Carolina home health agency that we worked with to help them claim a total ERC refund of over $620,000. Another Virginia home health agency that we helped claim over $884,000. And a Maryland assisted living facility with just 36 employees on staff who we recently helped claim a total credit of in excess of $323,000. So with that, that's the end of my presentation as far as the ins and outs of how the employee retention credit work. And I'd like to open it up to your questions moving forward. And Mindy, it looks like you had something in mind already.
Hi, Matt. Thank you for that. It was very comprehensive. I've actually been looking into the ERC, so I'm familiar with what you shared, and I actually got some new information, so it was helpful. And excellent. I think my brother Neil may have spoken with you at the annual conference.
Okay, wonderful.
My question is, what is under the government mandate test? What is a very specific example that you've been able to use for, or that you know how a home care company, so not a facility, but a home care company has been able to qualify?
Sure. I would say the first and most obvious one and most common one that we're seeing is the reduced ability to market your services because of your inability to enter these facilities that I was talking about earlier, whether it's going into a hospital or another assisted living facility to communicate with the healthcare practitioners, which are often sending these types of businesses referrals. And for a lot of businesses, this is how they gain most of their business, is by garnering referrals from other healthcare providers. Another good example, though, would be that of the enhanced cleaning procedures that home health agencies were required to employ during the pandemic, and how the significant amount of additional time that the business's employees had to spend on sterilizing and cleaning both the instruments and the rooms and areas that they're performing their work. Because of the additional labor involved with these enhanced cleaning procedures, they experienced a significantly reduced ability to provide their services, because so much of that labor was diverted from, instead of providing services to their patients, instead diverted to employing these enhanced cleaning procedures. And that, I think, is a great way to think about the employee retention credit, is that it's not unlike eminent domain. So with eminent domain, if the government wants to come in and build a road through your farm, they're required to offer you a fair price for that land in order to seize that land and build that road through your farm. Well, not dissimilar to what we're dealing with here with the employee retention credit, where these government entities came in and said, you guys are ready, willing, and able to do the work that you've hired your employees to do. However, instead of doing their normal job, we're going to take 10, 15, 20% of the hours in their day and divert those toward enforcing the policies that they had put into place, such as requiring social distancing, requiring enhanced cleaning, etc.
So on the first example, the reduced ability to market services, would the government expect a company, like if it was audited, like, do we have to, would there be a portion of that qualification requirement to be able to show that company, the business decreased a certain percentage because of the inability to market? I mean, because how does that work?
Yeah, so there are a couple things to note there. First of all, there is a tenet in tax law called the Cohen rule, and the Cohen rule says that a business is not necessarily required to maintain a record that it would not otherwise maintain in the normal course of business in order to substantiate a position taken on a tax return. So clearly, for no business that I'm aware of has ever been tracking its ability to provide goods and services during the normal course of business. And so what that means is that we have some flexibility as far as how we demonstrate, this reduced ability to provide goods and services. But I'll give you an example. If you have a business that was making 35% of its money off of referrals that it was receiving from healthcare practitioners prior to the pandemic, and then for a vast majority of the pandemic, at least during the ERC eligibility potential window, it was unable to enter those facilities to further those relationships with its referral partners. That would be a great example of how it experienced a diminished ability to provide its service.
Okay, great. Thank you.
Absolutely. Let me see if we had any other questions here.
Matt, can I chime in with a really stupid one?
Yeah. No
Caitlin,
stupid
I'm sure it's
questions.
not stupid.
Yeah, no
Is there a
stupid questions.
deadline? Is there a deadline to file an ERC claim?
Yeah, great question. So this is getting back into the weeds on the tax law stuff, but basically what this comes down to is that a business has up until April 15 of 2024 to file an ERC claim for any quarter during 2020. And then until April 15 of 2025 to file an ERC claim for any quarter during 2021.
Thank you.
Absolutely. Any other questions that I can answer for anybody?
I'll ask another one if no one else has. So I do know, I mean, what you shared about a lot of fraud, unfortunately, around this program. But because of the potential of an IRS audit, and even if the company's operating completely ethically and above board, but do you, in the event of an audit, my understanding is the IRS can claw back that money. Do you ever recommend that companies like put the money aside? Is there, like, how long is the audit period?
So the audit, that's another good and interesting question. And so as part of the American Rescue Plan Act, the IRS extended the audit look back period for ERC claims from 3 years to 5 years, but only for the third and fourth quarters of 2021. So
5 years based on when you file, or when the time period, the 20.
Yeah, so that's a hairy one there. So first of all, it's 5 years for Q3 and Q4 of 2021. For all of the other quarters, the audit look back period as it stands right now is 3 years. And that's 3 years from what the IRS calls the deemed due date of the payroll tax return. So again, most of the businesses that are on today likely file a Form 941 each quarter to report the payroll or the wages paid to its employees. However, there are other types of payroll tax returns which are only filed on an annual basis for certain types of small employers and also agricultural employers. And so in order to establish parity for these different types of filers, the IRS established what's called the deemed due date of a payroll tax return. So for any payroll tax return for any given year, any 941 is due within 1 month of the close of each calendar quarter. However, again, to establish parity, the IRS has established this deemed due date for all payroll tax returns, which is always going to be April 15th of the subsequent year. So we'll take Q2 2020, for example. That 941 would have been due by July 31st of 2020. However, the IRS's deemed due date for that return is actually April 15th of 2021. And then the statute of limitations to both file a claim and for the IRS to audit that claim both falls 3 years from that date, meaning that we have until April 15 of next year to file that claim. And technically speaking, as it stands right now, the IRS has the same day is the deadline to audit that claim. So unfortunately, that is just one more thing that has introduced more opportunity for unscrupulousness, we'll say, in this space, because businesses see that, oh, well, if I go and file a claim on April 14 of 2024, the IRS has until the next day to select that claim for audit. I mean, Congress really, really bungled this stuff. It was not a good rollout whatsoever. Now, I will say that, again, first, for the third and fourth quarters of 2021, that audit period is extended to 5 years. So they would have until April 15 of 2027 to audit claims for the third and fourth quarters of 2021. However, they did not extend the refund statute expiration date, meaning that you still only have until April 15 of 2025 to file that claim. I will also say, though, that there has been some talk in Congress, and there was some preliminary talk as part of the debt ceiling negotiations to establish and lengthen the audit look-back period for all of the quarters to 5 years. However, that never made it into the legislation that was eventually passed as part of the debt ceiling negotiation. Now, that's not to say that that's not still a possibility in the future. Remember, Congress has already changed the rules on this stuff at least 3 times. So there is always still that possibility in the future that that audit look-back period may be extended. However, as it stands right now, the deadline to file a claim and the deadline for the IRS to select that claim for audit fall on the same day, except for those last 2 quarters in 2021.
Thank you.
Absolutely.
Wow, I know we were joking at the outset, Matt, about just how highly specialized the work is that you do and the expertise that you have, but just within the past hour of you leading us through this, it's just it's very, very clear that folks really do need highly expert professional people who are well-versed in all of these nuances to lead them through the process. And I just can't thank you enough for spending time to educate us today, and for members of our home care community to be able to know the resource they have in smarter tax planning.
Well, absolutely. Thank you so much for having me, Caitlin. And just one last thing before I go, if anybody has any follow-up questions or would like to schedule a consultation, my contact information is on the screen, my email address, phone number, and website. And also down at the bottom right of the screen is a link that you can use to get started immediately. By following that link, that will take you to a URL at which you can fill out a brief questionnaire to get us some basic information so that we can start the process of analyzing your business's eligibility for the credit. So please, I hope to hear from everybody on the call at some point, even if it's just to call and ask what you might think is an obvious question. There is no such thing as a dumb question. I am happy to hop on a call with anybody here today. So again, thank you so much for joining us, everybody, and I hope that everybody has a wonderful week.
Thank you, Matt. Thanks, everybody.
Thank you, Caitlin. Take care.
Take care. Bye-bye.
Thank you.